Hello, everybody. Welcome to Friday, another Talk Money with Tom show here. We're coming live from Silicon Valley, and we are trying to help you improve your retirement planning, how to do the investing, tax planning, all of these different areas. And so you can feel free to kind of send in questions now if you'd like. We try to answer them live during the show. You can send them in during the week also. You can use this email address, asktom, talkmoneywithtom.com. Or if you want to, you can put it in the chat right here on the channel also. So, we really enjoy this. We try to, help the clients as much as possible, help the public. We feel like there's sort of a missing area of education here. So feel free to send in questions that you might have. We often cover things that come up, during our client review sessions also. So obviously you can go to the channel itself, see some of the things that we put on here. Get yourself, some more education. You can subscribe to the channel, put a little bell button there. You'll get notified when we put out anything new. And then, of course, you can just set up a time to meet with us if you'd like. We have a book appointment button on our website. Link for the website's here on the channel. Button looks just like that. It's up in the corner, and you can schedule a 30-minute time to meet with Ethan and I on the phone, in person, video, whatever works best for you. So. Anyway, looking forward to today's show. Hopefully everybody grabs onto something here that they can, use going forward. I do like to start off the show every time talking about what we saw in the market this week. Pretty good week. We hit new all-time high quite a few times this year. We hit 42 times that we've hit a new all-time high this year. I mentioned that in my daily videos, and somebody asked, what's the highest in any one year, which I didn't know. I went and looked it up, and it's actually 1995.
Yeah, that was a great year.
Yeah, 77 highs. And so the next closest one was actually 2021, which is another really good year, with 70 highs. So I don't know that we'll get there. I think the real issue here for this year, it looked like 1995 at the beginning. If you look at the, that run up that we had from October through, the end of March, that looks just like 1995 if you go back and look at that chart. But it kept going all year long. And what happened this year? We're getting these, false signals in hindsight about, hey, inflation might be picking back up, and so we're in a little bit more tenuous environment than we had in 1995. However, still really good run. I mean, we've been going here. October 13th of 2022 was the low point of that bear market or down market that happened in 2022. And so, October 13th of this year, we'll be at 2 years.
Yep.
Yeah. And so the average bull market, if you go back to the 1920s, is 3 years, right? The average bull market, if you go back to 1970s, is actually 5 years. And the reason that it's longer now is because of the, kind of the financial engineering that goes on with quantitative easing and these stimulus programs and those types of things that they've discovered, that help us move maybe a little bit quicker and longer.
Yeah, they kind of try to stabilize as much as they can.
Yeah, it kind of juices the system, so to speak, which is fine. Obviously, the problem is we keep, increasing the debt load. And as long as we can continue to, sell our treasuries and, we can continue to do those types of things. But so nonetheless, just keep in mind that, this is still, I think, in the earlier innings of this overall run up, right? And, even if it's just 3 years, we still have a year to go, which would be fine, as far as that goes. And what they look at here, what ends these runs is a 20% or more downturn, because that's officially now called a bear market. In our case, that means the primary direction is now down, that kind of thing. So primary direction is definitely still up. Market is doing quite well, actually. I will say it continues to rotate, right? We're seeing, kind of day by day, all of a sudden the small caps are doing well, and then they're not doing quite as well. And then, we got the utilities run, and then they stop. These runs are not very long, right? And so it's very difficult if you're, like with our target pieces, to kind of stay ahead of a trend that doesn't last for very long. And again, the big win here is to have very broad portfolio in this time frame. If you go back to 2021, which is the last time I remember this type of thing happening, the big winner was like the Vanguard Total Stock Market Index. It had the small caps because it basically has all caps. I mean, it's almost all of the stocks in the U.S. market. So I would definitely encourage, and we're doing the same thing, a broad spectrum for a big chunk of your portfolio if you have that capability. And last year, the beginning of this year, you could have, pump money into the big seven and outperform the market, right? And that's not as true right now. I do think there'll be a trend that is established here at some point in time. There always is. I think, there's too many cross currents right now. Inflation, no inflation, recession, no recession. Who's in the White House, who's in the Congress, right? And so it's just going around in circles. However, overall, it's still going up. And actually, we're going to end up, it looks like, with a positive month in September, unless there's a really big day. I think the last day is Monday.
I think so. Yep. Monday's 30th.
So that's not that common to have a up month. However, we did present on the show during presidential election years. September does buck its trend by being up slightly. On average, going back to 1898, I think we did that one. That was actually the Dow looking at, but same thing. Well, not same thing, but
similar.
It's the market. And so I think that's important too. I'm impressed with what's happened here. So if we zero in a little bit, I showed this last time. Now we went from weekly data in this case to daily data, just looking year to date. So you can see the downturn we had in middle of July to August, and then we fell again at the beginning of September, and then we finally broke through to a new all-time high. And what's really powerful about that is how long we spent. If you look at that, I mean, basically going back to May, we've in that same time frame of price, right? In this kind of range. And so we built up a really good base. We broke out of that base, and now more importantly, we're staying above that base, and we're not coming back in. And it's looking more and more as we're here now a week out on this run that we are going to stay above this base. Now all of these things are predicated on kind of momentum and things happening, the past 5-year runs that the market has, and all those things. You can always have something that changes whatever momentum you have, right? I always talk about if China invades Taiwan as one thing that comes up in my mind that would, doesn't matter what type of bull market we were in, we would be going downward in that scenario, in my opinion, just because Taiwan makes so much of the semiconductors that the world kind of relies upon. So that would be a big deal. But nonetheless, pretty good market. That's a really powerful piece that you're looking at right here with this base that was built up over a number of months, breaking out of that top. At least what would happen if we did start to come back down, it would slow the descent, because there's a bunch of people that bought at those prices that now think, hey, if it comes back to this price, I would buy it again, and so there's some support now underneath this run that we're on right now. And we're heading into seasonal good times, right? That November, December timeframe and those types of things too. So really, really not a bad market. And again, this hasn't changed. Primary trends on all the different, hourly, daily, weekly, monthly is all green. That hasn't changed since the last one. And everything except for transportation is green here on the market breadth on the weekly data. So yeah, good stuff. Again, it's a good time to be an investor, in my opinion. There's been a lot to be made here. And unbelievable, really. I mean, because we made a lot last year, right? And so I have to do some study on this, but it seems like we have quite often kind of 3 years. So 2019, 2020, 2021, I believe all of those were over 20%. And then we, of course, had 22 with the big downturn. And so this is our second possible over 20% year if it continues to hang in here. And I don't see any real dark clouds on the horizon that would really affect us dramatically in 2025, especially if they're continuing to lower rates during that period of time,
and
too.
Interest and inflation is kind of abating.
Yeah, exactly. So, and we'll talk about that too. So here's today's announcement for core PCE. So now the thing about PCE, here we are on the 27th of September. This is for August, right? So it's a ways back. But it is the most important component of the inflation reporting because this is what the Fed looks at, that they're trying to get to 2%. A little hard to see this, but we've spent the last 4 months at 2.6 something percent year over year. So what that means is we look at August of last month. We would look at August of 2024 versus August of 2023. And we see, okay, prices were up 2.63% in this basket that they look at, right? And 2.68% actually in this case. So, but it's really flatlining. Probably should be getting better, but it's flatlining. And so, why did the Fed lower rates? Why would they maybe do a half a point cut? And so let's take a look. First of all, right now, the bet for the half point cut actually went up today. So even though core PCE year over year came in pretty much at the same number it's been at for the last 4 months, the bet went up that we'd have a half a point rate cut versus a quarter point rate cut, right? And we're up to what, 56.7% on the the futures market, which is what this represents. So we'll see. I guess I'd be a little bit surprised, but I was surprised by the last half point cut because they've already done a half point cut. There's nothing really going. However, there is one reason this bet went up, and that is because if you look at the core PCE on a month over month basis, so in other words, if you compare this August to this July in this year, and this July to June and June to May, etc., and you look at how much growth there has been. So if you take the last 3 months, if you just add them up, it comes out to 0.5%, okay? Rounded, but 0.5%. And then you multiply that times 4, that's 2%. That's exactly where they want to be. And so the reason they're cutting rates right now, and the reason that there's a higher bet on another half a point cut than two, say, quarter point cuts, is because it's already there. And once it gets there, there is some nervousness about getting below it.
Yeah, it's kind of like a train. You have to. It takes a little time to slow down the train, and so once you start to get close to that point, they're trying to slow it down.
Yeah, exactly. So that, and of course it takes so long for these things to really have an impact. And, so we're going to find out next year whether or not, this is working in terms of, did they leave rates up too high for too long this year? Maybe they should have come down earlier or not, I'd say it's kind of a mixed bag here on inflation, but you can see where the market is looking as far as that goes. And so now here's something, that is really kind of the main driver of the inflation basket is shelter. Not the main, but one of them.
Yeah. It's heavily weighted in CPI and PCE because everyday life, your shelter is such a big cost.
Yeah, and you can see what happens to shelter costs during a recession. Back in 2008, it can go down. But look at what happened to shelter costs during a pandemic. It really went up. And there's a couple of reasons for that. I mean, one of the main reasons is that, you had a scenario where you lower interest rates. So, mortgages were cheap. That gets a lot more buyers in there. But house prices went up. I can't remember which year it was up 24%. It was either 2020 or 2021, probably 2021. And so, you get that kind of a explosion in gains and prices. You're going to end up with, people that can't afford it. So they're renting. And part of this is the equivalent rent for people that actually own homes, right? And so it's kind of fascinating, but it is coming down, right? It's got a ways to go to get back down into some average area, but this is an area that has to keep coming down in order for inflation to start to get all the way down to where it needs to go.
It's a sticky thing because it's hard to add new supply, whether it be rental units or just general housing that people can buy. It takes time to develop properties.
It does. It takes time you could have a lease, you're in a place, it's higher than what you might have to pay in the market at the moment, but you've got a year lease, you still got 6 months left. And so it tends to be kind of slow and lags quite a bit too. So, but this is one of the big things, and, rents are pretty out of control in a lot of areas. So we'll, hopefully they can get better over time, but we'll see how this plays out. One thing, we were talking about kind of this weird relationship. So you would think that the price of homes would have come down, right? When interest rates went from a kind of a 3% mortgage to a 7% mortgage, that's usually a death knell, at least for the short term, for the price of housing. It didn't come down. And one of the main characteristics or one of the main reasons for that was because all these people refinanced at 3% or even below that. And it dried up the people that wanted to move, because if you got from 3, now I got to move, I'm going to go to 7. And so we were kind of wondering about what happens if mortgages go back down to, say, 5.
Yeah.
Right.
Does more markets or do more properties come on the market because people are wanting to move, and there's felt locked in with that 3% loan.
Yeah, it's kind of like backwards, right? So prices didn't go down when rates went up because of this 3% big group of mortgages sitting there. Can house prices actually come down when rates come down,
Yeah,
which is totally not
yeah.
what normally
Will
happens?
it add supply
Right.
by people moving?
Right. Well, bring in enough supply to kind of soften up the market. It'll be interesting to see how that plays out. That's not normal. Let's put it that way. So anyway, that's one of the things we're looking at now. The other big story really had to do with China. So this is a ETF iShare has. It's a kind of a big basket of Chinese stocks. It's the one we generally look at when we want to look at the Chinese market. This is the last 5 years, right? Mm-hmm. And you can see just over Easton's head here, the thing is really going.
Yeah, I think it's 20% in the last 5 days.
Yeah, so this is because China had a stimulus package, a big one that they put out that the markets are excited about, and we're seeing all kinds of different arenas where it's kind of flooding into gains in those particular types of stocks. But here's the point that I want to make about the overall market. Some time ago, I said, during our higher inflationary period, I said, I'm kind of glad that China isn't really hot right now economically. Mm-hmm. And they were struggling, the COVID lockdowns were later than a lot of the countries, including us. And so they're kind of offset. So the rest of the world is moving along and starting to get some of their growth, and the U.S. is doing the best really out of the big countries in terms of gross domestic product. But if China would have been hot, I think inflation would still be up there. We'd still be cranking on rates and those types of things. And my wish was that they would get hot when everybody else started to slow down, and it might keep the rest of the second largest economy in the world, might keep the rest of the world out of a heavy recession.
Yeah, they can drag everyone up.
They can kind of come up. And so it's kind of this wave that's coming behind. And I think this is really fascinating. And at the time when we were talking about that, the concern was, China's going to fall apart. They got this big real estate problem and all of these issues. They actually have deflation, unlike ours. With our inflationary issues. And I mentioned that, they'll probably just do what everybody else is doing. They'll throw out a bunch of stimulus money because it does work. And, the parties in power don't want to have everything fall apart. So if they can get money out there, they'll do it. And there's going to be something that gets done all the time. It's happening now more often in the U.S. since 2008, right? Mm-hmm. And these are tools that they'll continue to use. I do think there's some danger in these tools that keep accumulating, higher debt levels and kind of pushing out sort of a sugar high onto the market, that may not be completely accurate because this government money keeps coming out. However, that could go on for generations for all I know. We'll see how that plays out. But anyway, the stimulus package, I think, will be a big piece of what happens here because it'll translate to us. They're buying products that are made by U.S. companies, and U.S. has huge exposure to China in China. We're selling to China also, right? I mean, whether that's Teslas or what have you. So anyway, that's I think this is a big piece of the story that happened this week also. And so again, good week, lots of good things happening. Inflation's doing okay. Annualizing it out for the last quarter, we're already down to 2%. All of these things that are happening, and the market continues to hit new all-time highs. It's not going up as much as it probably could have been if it was November. We'd probably be going a lot faster right now, in my opinion. We're still heading into this election, so there's still going to be money that holds back here just because, the uncertainty. There's a lot of money that wants to play a particular angle, and the angle kind of depends on how Congress is made up and who's in the White House as to where you might want to play that angle. So, if I got some money coming in, I might want to wait for a while, wait till after that election's done. I'll know what angle I should be playing. They're probably gaming all this out. Mm-hmm. We don't do this, but there's a lot of big hedge funds out there that do this. So, that type of thing is bound to slow down the market at least somewhat until the election. But usually you do get a really nice pop after the election. So we'll see how that goes. So anyway, look forward to being able to, see what's going to happen next week. Thank you for joining us for this particular summary. All right, let's start with our first question.
So what would a soft landing look like?
Okay, so there's a hard landing, a soft landing, and now a no landing. These are all, some of these things are newish concepts in terms of how they're describing them. Remember, like disinflation.
Yeah.
I'd never heard of that before. But, there's inflation, prices going up. There's deflation, prices going down, and disinflation, prices not going up as fast. Okay, these are all almost making up new vocabulary words. So a soft landing would be a recession that maybe you didn't even know happened, right? Because what happens is there is an organization, do you remember who it is that decides who does? There's an organization that basically declares that we have a recession. And they have several different metrics that they're looking at. One of which, of course, and the biggest one, as far as I know, is the 2 quarters of negative gross domestic product growth, GDP growth. And so that's an area that, we're not even close to. Matter of fact, our GDP growth was just reconfirmed at 3% for the second quarter. And so that, we're not there. But
so it's the National Bureau of Economic Research, I believe.
Yes, that's it. And so oftentimes it'll be about 3 to 6 months after the recession has actually started before they declare that we have one. So I remember one recession, I think it was in 94, which is the last time we had a soft landing. Nobody knew we had a recession until this group came out and said, hey, we just had a recession. And so that would be kind of an example of a soft landing.
Yeah, so the idea is that inflation is close to the whatever sustained target is. Employment is higher than usual, but it's not low enough that it causes, inflation again or increasing prices.
Right.
And then interest rates are kind of raised to slow and reduce like growth rates.
Yeah. So it's what from the get-go, Janet Yellen and Chairman Powell, Yellen's the Treasury Secretary, Powell's the Chairman of the Federal Reserve Board, have been talking about the fact that they feel like we can end up with a soft landing. And that's been going on for a year and a half, 2 years worth of conversations from them saying that, and that's still in play. We're still waiting to see what happens. So far, we've had a no landing. There's not been a recession, right?
Yeah.
And you can make a pretty good argument that we're not going to have a recession, even a soft landing, just because things are going pretty well. Now that they're lowering rates, and if they keep rates going on the right side, we could have no recession whatsoever. And I wouldn't be surprised at all. I guess the only worry I have about that is that you got to be careful that doesn't reignite inflation, someplace in there. So you get a stock market that's going bananas. It would probably continue to go bananas, if they continue to lower interest rates, and you start to get a potentially tight job market. So we're in this weird scenario where we can teeter-totter either way, and we're trying to find that middle ground, kind of that Goldilocks scenario, and lo and behold, we have been doing that Goldilocks scenario for the last couple of years, and that isn't what anybody on Wall Street predicted last year, I'll tell you that much. They really, really missed last year big time. So, go with the flow, keep things going. Look at the stock market. The stock market is a leading indicator, not a lagging indicator. It's a leading indicator. I remember my grandmother used to always ask me, why is the stock market going up when unemployment is getting worse and worse, And it's because the stock market was looking at the next phase, right, which was going to be a positive phase, and it already had discounted, this bad phase that we were currently in. If you looked, it probably had some downturn prior to that, because again, the stock market is a really good leading indicator. Probably the most well-known leading indicator basket is the LEI, the leading economic index. And it only has 10 indicators in it, and one of them is the S&P 500. So watch the S&P 500 if you really want to know. So what's that mean to you when we're hitting all-time highs 42 times this year? Could be some good momentum coming in economically, right? So because we wouldn't be hitting 42 all-time highs if earnings were falling apart and there was some kind of indicator, or even forward guidance was terrible or what have you, right? And you can pick any one company, you can find things falling apart, definitely, even in an industry. But if you look at the whole thing across the board, let's say the whole S&P 500, earnings expectations are really continuing to grow, and rightfully so. I mean, there's a lot of great products, things that are happening. The cloud is exciting. It's a reoccurring revenue for these companies, for Microsoft and Amazon, Apple, et cetera. So really not a bad time to be an investor whatsoever. Soft landing is kind of what it looks like is happening so far. Again, always keep in mind, these are kind of what we're talking about is more like the averages, right? What should happen based on the averages. Mm-hmm. You can always have something unusual that happens that can wipe out whatever trend you're on, and we could end up in a hard landing, because of that.
And black swans always happen.
Yes, something. As a matter of fact, I read a great article saying that the investing public is still waiting for the other shoe to drop, like it did in 2000 and like it did in 2008. So something that is underground, like in the case of 2008, it was credit default swaps, mm-hmm. right? So credit default swaps were basically bonds of mortgage loans, right? Yeah. And put them all together, sell them worldwide, take that money, go do some more mortgage loans. Pretty soon you're giving mortgage loans to anybody because mm-hmm. you got to get them out there. Yeah. And then the whole thing collapsed. And there was $7 trillion worth of credit default swaps in like a 5-year period. It was a private market. Even the Federal Reserve didn't really seem to understand it. Treasury didn't seem to understand it. And Lehman collapsed and all of it came to light, right? And so that's what was worrying. And anyway, this article was talking about, we've been through enough vacillations here over the last, say, 3 years from the big downturn in 2022 that, it seems like any bubble that was under the surface that wasn't, identified would have probably already burst, which I think is interesting. I do think there's a lot of kind of like junk debt. We hear about these like junk car loans and there's things like that. And so, you never know. And that's what happens is it's usually in some kind of private area that really isn't discussed as much because of that. But we might have already kind of gone through a lot of the pieces that, that would have created problems. So anyway, we'll see how that goes. Soft landing still seems like a viable option. All right, what's our next question?
So what are your thoughts on the Chinese stimulus package? Should a China ETF be on my radar or in my portfolio?
Yeah, well, let's share that screen again here too. Here we go. So here's a China ETF.
Yep.
Yeah, pretty popular one. This is the last 5 years. You can see the giant run that it's had just right over Easton's head there. And but at the same time, you look at that overall chart, I see a few things. First of all, it's pretty volatile. I mean, those moves, even that one over your head is roughly what, 40 to, wow. To 50.
It's a 18%, I think.
Yeah, well, 20. Well, not, yeah, rough from the bottom.
Yeah.
That's a 20% gain. So look at these things. So if you look at that and think, okay, that's 20%, look at the rest of that chart, that's moving a lot. Mm-hmm. We don't use these types of things because they move too much. And, the last thing you want with a client is to be sitting there and saying, oh, wow, it got out of hand and we're down 40% before we can, deal with it. And especially when you're in an up market mm-hmm. altogether, that can be, if everybody's losing money, it's a little easier to handle. But if you're just losing money, so I guess that's one issue I'd be a little careful with. Maybe keep the dollar amount smaller. The other thing I see here is that we're still kind of in a range. If you look even, when does this go back to?
Yeah, do you think once it breaks that 56, that old high?
Yeah, that's at least something, right? I mean, so there's some resistance there, I would imagine, as far as that goes. But you're going to have a fair amount of resistance all the way up because of that huge downturn. And that wasn't that long ago, right? So one of the things when you look at support and resistance, you look kind of at the past price. More prices that are closer to today make mm-hmm. more impact than prices from 5 or 7 years ago. Well, this thing peaked out in 2021. So that's not long enough ago to say that it's, not going to have an impact. So it's going to have an impact. And you're going to have to overcome all of those, difference points to kind of really get moving. And so you're going to have plenty of points in there where it's going to come up if it is going to continue to go mm-hmm. up, and then retrace and come up and retrace because it has to dry up that selling, pressure that's above it. So that's something to think about. Again, we don't do it. I don't have any particular problem with it. China is not going away anytime soon. They may have some issues with the markets, the way the markets are run. The transparency of the companies is something that really And a lot of Chinese stocks get kicked off of some of these other exchanges.
For having bad accounting practices or reporting.
Yeah, or none.
Yeah.
So, it's just a totally different world. Be aware that that's how that works as far as that goes.
Yeah,
but
if you don't want those kind of risks, there's some alternative plays. You could look at kind of consumer discretionaries, ETFs that maybe have your European luxury brands.
Yep.
Hotels is another play. China has a very strong traveling population, so if the economy is good, people are traveling.
Yep.
So those resort and hotels tend to do well too.
Yeah, exactly. So, I mean, because this is going to be the next portion, in my opinion, if the stimulus works, and maybe they have to do more to get it to work. Who knows? Because really the real estate issue is just ginormous. I mean, it's incredible what they've done there. They just kept building and building. But let's say that it does start to work. The prosperity comes into China. It will come into the rest of the world too, because they do travel a lot. And so you can see, that coming through in other areas. If you didn't want to go into kind of non-transparent Chinese market directly, you could maybe be looking at travel and leisure type ETFs in general, as far as that goes. So, there are some pieces that are going to continue to be impacted, hopefully to the positive. And again, my overall theme of this was, it was good that China, at least from a worldwide perspective, wasn't hot and on fire during the period of time when we had high inflation. It would have been much worse, and we'd still be looking at high inflation if it was. But the fact that they were kind of struggling for a while, and maybe there's just a lag when they start to get going, and that lag fits in when the rest of the world starts to slow down and keeps everybody out of a recession of any hard type. That would be, I'm dreaming here, but that'd
be an ideal situation.
Yeah, that's an ideal situation. It's a possibility too, as far as that goes. So yeah, you look at that chart, there's quite a few spots there where it is hitting resistance right now. And it'll have to, churn through that. So you might be able to get this on a little bit of a bounce back, because it's going to take a while to get through. There's 3 peaks, 4 peaks, and 1 trough all the way across, right at the price it's at right now. Yeah. So, I might if I was going to buy this, it would be, just below where it is now, put in a buy. It's at 50, put in a buy at like 48, and probably, save some money. So anyway, it's a good question. China's a big deal, worldwide here. They've got a ways to go to really get things rolling again. But if they get things rolling, we'll all know about it.
Mm-hmm. So what does a falling interest rate mean for the average household, U.S. household?
Okay, so falling rates are coming down. Rates are all kind of connected to the Fed funds rate, right? So the Fed sets these rates. That's why we spent so much time talking about it, because it's a really important component. The next meeting is November 7th. How much they're going to lower rates, but they just lowered rates 0.5%. So what's that mean, right? Kind of depends. It depends on is your household borrowing money? Because if you're borrowing money, whether it's credit card or mortgage or car loans, generally speaking, when rates come down, those will all come down too, and your borrowing costs would come down. So
for a mortgage, you have to refinance to capture that, but you have that option if you have a high interest rate. Consumer debt and car loans, I guess you'd be locked in wherever you have, but like credit cards float.
Maybe a new car that you went out and bought. Sometimes you get good rates anyway, because basically the manufacturer is just eating it. They give you 0%. They're probably paying more than 0, but they're going to eat the difference to try to get the inventory to move.
So as a borrower, you're kind of saving money. As a saver, you're kind of losing out on that high interest rate. Yeah. That's the other side of the coin.
That's the other side of the coin. So this is kind of interesting for, a lot of our retired clients. They don't have any debt at all. They don't have any credit card debt. They often don't have car loans. They don't have mortgage loans any longer, So all of this downturn of rates really comes through to them as a positive for the stock and bond market, which is where, why they're clients. So that's a good thing. So it does help. But in terms of their personal savings, money at the bank, maybe T-bills, CDs, savings accounts, high yield savings accounts, all of those start to pay less.
Yeah, and so like anything you have that has a floating rate will come down, and then anything that has a maturity date on it, whenever that matures, you'll probably get a lower rate than you previously were getting.
Yeah, I did see an article saying that the number of refinances has really skyrocketed. just recently in the last couple of weeks because of the drop in rates for mortgages compared to the higher rates that were out there, and
Yeah,
people are already doing it.
yeah. I think if you can get like a 1 to 2%, it becomes worthwhile to do that refinance.
Yeah, exactly. I mean, they've got all these things now where you can do, with no point, no fees, and so you can get a little closer on the rate. And a 1% on a big mortgage, it's a big deal.
Yeah, over that time of that
Yeah.
lifetime of that loan, you
Yeah.
save a lot of money.
Yeah, exactly. And that's the one advantage of, of how that works. I bought this house at 7% mortgage. It's hard to do, but you might not be at 7 forever, right? So
Yeah.
now already maybe you can go down to 6, and maybe it goes to 5 next year if rates continue down. And so really you bought that house temporarily at a 7% mortgage, and
Yeah, and
you
so that's
keep
why we
going.
tell people you don't, if you have the money in the funds, you don't hold it off because you always have chances to refinance in the future.
Yeah, because unfortunately, it's a good chance that if you wait for rates to come down before you buy that house, it's just
Everyone
going
else
to
is joining
cost.
that.
Yeah, well, it's going to cost. The house prices have been pretty resilient.
Yeah.
So yeah, that would be a problem. All right, that's a good question.
How are taxes calculated when surrendering a whole life insurance policy?
So a whole life insurance policy is, there's a term life, that where you buy it for a certain term. There's no cash buildup, right? There's universal life and there's whole life. And whole life and universal life both can get a cash buildup inside that policy. Whole life tends to have more guarantees and, grows fixed interest rates and those type of things. And so it works just like an annuity. Whatever you put in, you already pay taxes on that.
Yeah, so basically your cost basis is your premium.
Yeah, whatever premiums you put in, you can take back out without tax. The interest gains over and above that premium would be taxed, and they're taxed at ordinary income.
Yeah,
right?
There's no capital gains.
No, there's no
Unfortunately,
capital gains on annuities, or whole life policies. A whole life policy is essentially kind of a combination of a life insurance with an annuity, really. I mean, it's sort of a blend of those two products inside these insurance companies. And so, it's an okay area to get money if you need to. Obviously, if it's the only area you got, then it's fine too. But just be aware of some of the tax consequences of that too.
Yeah, you have to evaluate, is this tax worthwhile, whatever opportunity cost you're going to use. Are you surrendering it because you need the money? Are you surrendering it because the dividends or the interest is not paying premiums anymore?
Right.
Are you surrendering because you have a better investment? If you have a better investment, does the tax cost more than the actual investment outperformance?
Yeah. Yep. All right. I think we have time for another one here.
So what is a deemed filing for Social Security?
A deemed filing for Social Security. Okay, so we used to be able to do a file and suspend.
Correct.
Right.
That was a loophole, and then I think in 2016 they kind of set up a policy that essentially you have to be a certain age to do that, and basically it phases out.
It phased itself out now. It's just a deemed filing. So under a file and suspend, you could take your spousal.
So the higher partner would file their Social Security. So you can't take spousal benefits until the other person is filing their Social Security.
Yep.
So they would do Social Security long enough that you could the lower income could file and take Social Security under spousal benefit, and then what they would do is they would suspend their benefit.
Yeah. So I have the smaller benefit. My spouse has a bigger benefit. My spouse files for Social Security, starts getting that bigger benefit. I hold on to my personal Social Security and I basically put it in suspension, and maybe I'll file at age 70 so it can keep growing. But I can start to get income now by taking a spousal benefit, which would be half of the bigger benefit that was done. And so you can't do that anymore.
Yeah, so, people felt it was kind of like manipulating the system, the idea.
Yeah.
And so what they replaced it was deemed filing. And so deemed filing is basically you file for your spousal benefit and your regular Social Security benefit at the same time, and then they pay whichever is higher.
That's right.
So you there's no way to do both.
That's right. Exactly. And so that Social Security has a lot of little rules and issues and dealing with divorces, and it's an amazing all kinds of different things that you need to know about for Social Security to really be able to kind of maximize what you get out of it. And it can be kind of a controversial subject only because you have a choice as to when you take it between 62 and 70.
And the problem is you're predicting for unknown end date.
Yeah. Yeah, exactly right. And so if you delay it, then you gave up benefits that you could have taken.
Can you outlast
Can
it?
can you get back to break even because now you're getting a bigger benefit, and how long does it take until I make up for the part that I didn't take? A lot of times it's around 77, 78, it depends on the
late
situation.
70s, early 80s is kind of
That's
that
right.
usual break even.
And so if you live past that, then you've done the right thing by delaying. If you don't, then you didn't. And so, and obviously none of us really know how long we're going to live too. So I will say, again, and I'll emphasize this all the time, but in the financial planning world that we deal with and looking at planning, the hardest part isn't dying too early. Because that's unfortunately in that situation, there isn't a big stress on the money anymore because you're not there to need that money. And what the real problem is living a long time because just look back at the last 20 years, how much cheaper things were 20 years ago, and think about your retirement being 20, 30 years long, whatever it might be. You live well into your 90s, you can have some trouble, and that is an issue here in this country with kind of this older population that's just kind of stuck. Can't get a job, don't have enough other income and assets to make up for these increased costs, and so is what we work on all the time. It's why we really push people to kind of stay in there and keep going, and because you're going to need more money than you think if you live a long time.
Yeah.
So but it's a challenge because the same problem we have with financial planning in general, we don't know what age to plan to. And we generally plan to age 100, but that's just kind of picked out of there just because.
We'd rather you have extra money
Right.
than no money.
Right,
That's when you're kind of looking at those scenarios.
Yeah, exactly.
So it's kind of a balancing act.
Yeah, exactly. All right. Well, that's our show for today. I want to thank everybody so much for coming. I really enjoyed all the questions today. Please feel free to send in the questions. You can send them, during the week. We can maybe find some charts or, do some research on it. So ask Tom at talkmoneywithtom.com. Send that question in. Be happy to answer them on the next show. Obviously, if you want to continue, looking at some of the content that we have, you can go to our, channel here that you're on. There's almost a couple thousand videos now, and hit the subscribe button. A little bell will get you, notified whenever we put something on there. And of course, you can book an appointment with us if you'd like. 30 minutes with Eason and I, and we can answer some of your, questions on a more customized basis. All right. So I want to thank everybody so much for coming, and look forward to seeing you next week.